This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, everyone, and welcome to this special broadcast of the Market and Economic Wrap. I'm Trevor Garvin, Head of Multi-Management at Net Group Investments. South Africa's Finance Minister delivered the 2025 medium-term budget policy statement on Wednesday, the 12th of November, yesterday. And today I'm sitting with Isaac Macheko, Senior Economist at Nedbank, to review key highlights that we feel were done within the medium-term budget policy statement. Isaac, welcome to the Market and Economic Wrap, and thank you so much for joining us today.
Hello, Trevor. Thank you for having me.
Great to have you here. So, Isaac, let's get straight into the meat of the conversation. From yesterday's policy statement, it appears that South Africa's growth forecast remains subdued. So the GDP growth for this year and next year has been marginally reduced. For this year, I know they reduced the GDP number from 1.4% down to 1.2%. What do you consider to be the main drivers behind this, and what needs to change to allow the country to get to a higher, more sustainable growth rate?
Thank you, Trevor. Yes, definitely the growth forecasts for this year have been revised slightly lower, and also for the subsequent years, particularly 2026 and 2027. But after that, there's an expectation that growth will pick up. And where will that come from? It will come from the expected better global environment. And on the domestic front, we've seen the government, through the National Treasury, implementing macroeconomic reforms that are aimed at helping to unlock the bottlenecks in the economy. When we look at the major network industries, and we're talking here about electricity, we're talking about the rail system, we're talking about water supply, we've seen significant inefficiencies over the past decade or so that have held back the growth of the South African economy. But just going back to this year, the downward revision of the growth forecast is due to a less than expected outcome in the first half of the year. And where did the shock come from? Primarily from offshore. The Trump administration's import tariffs have had a negative impact not only on the South African economy, but on global trade. Generally, we've seen global trade growing at a slower rate as a result of this trade uncertainty. But in the second half of the year, we do expect to see a pickup, with lower global and local interest rates, for instance, helping to boost local economic growth.
Perfect, Isaac. That makes a lot of sense and actually leads us quite nicely, I guess, into our next question, is how do global economic trends, and you've touched on a few of them, things like the Chinese economy, which South Africa is very dependent on, that's growing at around about 4.5% to 5% off the lows, which used to touch on sometimes 7-8% GDP growth. And you mentioned the trade tensions due to President Trump on his US tariffs and the impact that has on global trade. How do these things all affect the South African economy? Is South Africa's economic growth more driven by these global issues, or are they more driven and influenced by domestic issues?
No, ours is a small, open economy. Small in terms of size. We're not close to the size of the big two, the US and China. We are very small, and we are open in the sense that we are an economy that is dependent on trade, imports and exports. And just looking at China, China remains the world's largest consumer of commodity prices, and South Africa is still dependent on commodity exports, particularly mineral exports. And with China growing at a slower rate, it simply means that the China demand for commodities is lower, at least not at the levels that were seen in the 90s and the 2000s. So slower Chinese growth simply means that commodity prices are going to remain low. And that will impact South Africa's export earnings. So our growth, to a very large extent, is driven by what is happening globally. We've seen with the U.S. tariffs, the higher U.S. tariffs, some sectors are being negatively impacted. We are talking here about the auto sector, that is the export of motor cars and components of motor vehicles, the agricultural sector, particularly looking at, for instance, the citrus industry in the Western Cape and even some wine exporters. So we are dependent on domestic factors, what happens domestically, but also to a very large extent, the global environment, whether it's favorable or it is not so supportive of higher economic growth.
Right, Isaac, thank you. I think we need to speak about one of the most, spoken about and maybe controversial things that's been in the press for a while now and was included in the budget policy, and that is the new inflation target. So previously, we know that there was a band where inflation was targeted between 3% and 6%. So they used to aim for the midpoint of 4.5%. And now they've announced a new inflation target at 3%, which is, of course, on the lower end of the band. In your view, how significant is this shift for the economy and for markets and investors in general?
Trevor, it is very significant. We can just go back very briefly to when the inflation targeting policy was adopted in 2000. The aim back then was to gradually move the inflation target band lower. My recollection, I remember from my studies, I think the initial target was 4 to 7%. And in the inflation targeting policy back then, there was a clear indication that as South Africa's inflation declined, there would be that gradual move towards a lower inflation target. So that didn't happen back then. I know that at some stage the target was adjusted to 3 to 6%, but we were supposed to move to an even lower inflation target band about a decade ago. So we are just catching up with our peer economies. Brazil about 2 years ago lowered its inflation target to 3%, and we had not really moved. So, this is nothing new. The National Treasury and the Reserve Bank have for years been transparent about the intention to move the inflation target lower. So the policy transparency is quite encouraging. A lower inflation will not only benefit us domestically, but also internationally. For instance, lower inflation helps to protect the value of the currency, because inflation is exactly that. It erodes the buying power of a currency, both domestically and offshore. So if we can keep inflation at a lower rate, it simply means that the rate at which the buying power of the rand is being eroded will be lower, and that helps to keep the increase, for instance, in the cost of living at a lower rate. And of course, lower inflation is good for certainty. It's good for financial planning. It's good for people also planning their own budget. If we expect a stable increase in prices, we can factor that into our financial plan. So a lower inflation target, or a lower inflation rate for that matter, is good, beneficial for both domestic investors and consumers and international investors.
Yes, you're right, Isaac. I think certainty is really what the markets like, and a more stable currency and low inflation benefits that. So that's great. But equally important, I think, is South Africa's debt situation. And debt stabilization was highlighted yesterday as a milestone. What do you think this means for the government's fiscal sustainability? As well as, I guess, what ties into that is things like market confidence. And equally, I know debt is one of the things that the large rating agencies like Fitch, etc., look at when they do their country ratings. So do you think that this will help South Africa possibly get an upgrade after a number of downgrades that they've done over the last few years or so?
No. It was encouraging to see in the mini budget yesterday that the National Treasury remains committed to stabilizing government finances and actually bringing the debt level down. Our debt levels are very high, particularly compared to the similarly rated countries. South Africa is rated double B minus, which is in the double B category. And when you look at the median debt ratio of those countries, it is 55% in 2025. Our debt ratio right now is over 75%. And the National Treasury expected to stabilize this year, i.e. hit the highest level of 77.9 before starting to ease gradually over the next decade or so. So debt stabilization is very important. Remember that the more government accumulates debt, the more revenue it has to find. And that can just take us back, to the 3 budget statements we had this year. We know quite well that for the very first time, we had, Parliament almost on the verge of not approving a budget, and that was as a result of the very disputed VAT increases in the budget, which, by the way, were a result of subdued revenue growth. So government had to scratch around for revenue. So that stabilization is very, very key. And we are delayed in South Africa in the sense that, we should have stabilized our debt, before, for instance, the COVID shock, which pushed debt levels higher all over the world. But, what we saw in the mini budget yesterday was quite encouraging. Is it going to help us to at least move towards credit rating upgrades? It is the right step. What we expect when the rating agencies release their updates, and that should start happening in about the next 2 weeks towards the end of November. We expect, positive reviews. We know that, for instance, with S&P Global Ratings now, we are on a positive outlook, and with Moody's it's still stable, and also Fitch Ratings still stable. So I would expect, for instance, Moody's and Fitch to switch their outlooks to positive, which simply means that there'd be a good chance that if we remain on this improving trajectory, chances of an upgrade within the next 18 months will be quite high. But that, of course, will depend on what comes out in the February 2026 budget statement and the mini budget in October 2026 and the growth trajectory overall during 2026 leading into 2027.
Great. Isaac, I think we just need to touch on, perhaps to conclude, is the investment landscape. And if we just look at markets in South Africa at the moment, South African equities year to date have really been strong. They're up about 34%, listed properties up 21%, bonds are up 17%. So a really strong market across all asset classes. There's a lot of talk now in the investment landscape around things like infrastructure and private credits, where people are looking to invest as the next sort of chapter of investing. Yesterday, in the budget, infrastructure, energy and logistics reforms were mentioned. How transformative do you think this will be for long-term growth prospects for the country And what sort of role do you think private capital can play in driving these structural changes that we need in the economy?
Well, Trevor, we have a massive backlog in terms of infrastructure investment. Going back, we know that over the past decade and a half or so, we saw the public sector basically investing a lot of money in infrastructure, but unfortunately, the outcomes out of that were quite disappointing. As a country, we have not derived the full value of the money that we spend in, for instance, expanding Eskom's electricity generation. We've not derived the full benefit of Transnet operations, the ports, and all that. In the February budget, we saw an expansion of the infrastructure budget over the next 3 years, i.e. the medium-term expenditure framework period, with more than R1 trillion being set aside for infrastructure investment. Yesterday in the mini budget, encouragingly, there was an additional allocation for infrastructure, a lot of that to go to the municipalities. What we need to see in South Africa is the efficiency of infrastructure investment improving, i.e. with every R1 invested in infrastructure at the national government, at the provincial government, at the municipal level, we need to see more value being derived. And how do we achieve that? We must spend as little as possible, i.e. the cost of infrastructure investment must be lowered. And that is, the high cost is primarily due to administrative policy issues in some areas. The poor management of municipalities, for instance, result in a lot of wastage when it comes to spending on infrastructure. So that must improve in order to improve the operating environment. Encouragingly, we've seen Eskom to a large extent improving its generation operations, and as a result of that, we're heading for almost 200 days of no official load shedding. Transnet is getting a lot of attention to sort out the rail system, to sort out the ports, and also water infrastructure is a key focus in Operation Vulindlela. So as a country, to really improve the operating environment, to boost our growth prospects, we need to pay serious attention to sorting out the infrastructure and ensuring that, the investment that we are making really gets to give us the maximum benefit that we can derive.
Yes, I think you've summarized it really well there, Isaac. But just to conclude and really just to keep it very brief, please, I'm appointing you, Isaac, as Minister of Finance in the Cabinet, and you have got one key or critical task that you think you want to implement to get South Africa really on the right path of structural and economic growth. What would the first thing that you do as Minister of Finance be?
Well, Trevor, there'd be lots to do, but I'd start by reviewing policies, business policies in South Africa. Just as much as, the policies governing ownership in South Africa have got good intentions in terms of addressing the socio-economic challenges. I believe that after about 3 decades of these policies, it's about time to review them, to sit back and, decide how these policies should be adjusted in order to boost our growth prospects. Because I will say that, the world is a different place right now from what it was in the mid-90s when these policies were adopted. So we really need to be a flexible economy that can keep up with the dynamically changing global landscape. Because as I indicated earlier, we are a small, open economy. We are always hit by global headwinds, but often we fail to fully take advantage of the tailwinds that could help to boost economic growth in South Africa, attract a lot of investment, and in that way help us to deal with our socio-economic challenges.
Thank you, Minister of Finance, Isaac. I think that's a really excellent suggestion. Isaac, thank you so much for joining us today for this special broadcast of the Market and Economic Wrap. And I think you really shared with us some valuable insights. So thank you so much for that. And thank you to all of our listeners who have been tuned in and listened to the podcast. We thank you for that. So until next time, with thanks, Trevor.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.